Good afternoon from the 4th of CME. This is Chris Robinson with your trader's exclusive comment for today, Wednesday, December 5th. Very quickly, what happened post G20 meeting in the grains? That Sunday night, there was a lot of excitement. There was supposedly a deal on the books. China was going to start buying our commodities again sooner rather than later, and there was no follow through. So we're stuck here. We had a pretty good bounce, about a 25 cent bounce, which is about $1,000, $1,500 a contract for people that were long that Sunday night. Take a look at that chart. We also had two different things happen there that you should look at. We had a gap open higher, and when a chart gaps like that, generally it's a sign of strength. We did come back and fill a little bit of that gap, and I think that Thursday and Friday of this week, the number one thing the technical traders are going to be watching is, are we going to be able to hold that gap? Is that gap going to be the new support level for a move higher? The whole rest of the country, certainly soybean producers, are very anxiously awaiting to see if the Chinese will actually start buying beans. They've got a 90-day window to buy these soybeans between now and the time this deal is supposedly solidified. So there's a lot of uncertainty there. So the good thing is uncertainty provides movement. Movement is opportunity to make money. Also, you could lose money if you're not very careful. So, but we will be looking at movement, especially in the soybeans. So that's number one. We had a good gap open Sunday night and then not much follow through. The grain market is really in a trading range, okay? What does that mean? Well, if you look at a chart of corn, we're in a 20-cent trading range. Look at a chart of wheat, 30-cent trading range. So we've been trading back and forth. Soybeans, fortunately for soybean traders, they're at the top of a 90-cent trading range. Sounds like a lot, but this summer we lost $2.40 a bushel once the tariff ball really got rolling. So we've clawed back a little bit of it. We certainly have a lot more work to go. I think a lot of people are watching jam beans to see if we can get up to that 950 level again. That will be a sign of strength. That will be basically clawing back half of what we lost this summer. So we'll be watching those technical levels, but it really comes down to, are the Chinese going to open up their checkbooks? And then just in passing, before I leave, I did want to talk about the recent stock market volatility. I did spend 7-8 years trading in that Dow pit when we still had open market outcry. I traded it every day against the S&P and the NASDAQ. And I will say this, it's been a long time since I've seen this type of volatility. In the past 2 months, we've had 6 moves of 7% or more. You know, you don't need me to tell you that, but that's I can't remember the last time was. Certainly it had to go back to probably the dot-com days where we had that type of volatility. And I think that the number one thing I would caution people is, especially when you're talking about the Dow, it's the percentages that matter. It's not the point totals. We are currently about 1,000 points off the record highs. So even though we had an 800-point down move on Tuesday, where did that put us? It puts us 7% off the high. So the percentages are much more important than the point totals. Now, if you're trading one lot in the Dow, you know, 100 points is $1,000. So on a day where you have an 800-point move, on a one lot, you know, you can make or lose $8,000. So there's a lot of opportunity there, but I would resist the temptation to fall into the trap where people tend to get too emotional, worried about the big point numbers, the big point totals. It's the percentages that count. Have a great day. If you're looking for help, look me up online, Chris Robinson.